In a recent article from The Street, it was reported that Robert Kiyosaki, a popular financial author, was moving away from traditional assets toward Bitcoin and gold because he's convinced a historic market crash is already here. From a risk perspective, I see a classic trap in this line of thinking. It's the same trap that Warren Buffett has warned us about for decades. In this video, I'll talk about why the desire for this kind of financial security can actually be quite risky. I want to offer an alternative approach, one grounded in the timeless principles used by the world's most successful investors. There are really only two ways to look at an investment. First, there is supply and demand, and this is what Mr. Kiyosaki is betting on. He's looking for something scarce like Bitcoin, hoping that because there's a limited supply, the price must go up. But that's speculation. You're just hoping that someone else will pay more than you did for that asset. This is also referred to as the greater fool theory. Then there's also productivity. This is Warren Buffett's approach, and it's the core of the system I teach. When you buy a total market ETF, you aren't just buying a ticker symbol. You're buying a piece of thousands of value engines, companies that go to work every day to innovate, solve problems, and generate profit. So the key point is that in speculation, you need the world to get more scared to win. But in productivity, you just need the world to keep working. Mr. Kiyosaki's fear of a crash creates a state of the wait. I call it the wait. People sit on the sidelines clutching gold or cash, waiting for a safe time to enter. But here's the truth. You create your own personal market crash by sitting on the sidelines. If the market grows while you're waiting, you're losing wealth you can never recover, even if a crash eventually happens. And remember, even a broken clock is right twice a day. The productive growth you missed usually far outweighs the temporary dip you tried to avoid. So, how do we handle the big one without fleeing to speculative assets? We don't hide, we prepare by taking the following actions. We make sure that our investments are diversified. Using the S&P 500 ETF as an example, we own the whole market. We don't need to be right about one asset because we own the productivity of the entire economy. We make sure that we maintain a cash buffer. For those of us in or near retirement, we keep enough dry powder in money markets or short-term bonds to cover 2 or 3 years of living expenses. This is our safety net. If the market crashes tomorrow, we don't have to sell our shares. We let the value engines keep working while we live off of our buffer. And we can think of this cash buffer as a sleep well at night or swan factor. It removes the sense of urgency to act, and this gives you mental space to observe without reacting. Warren Buffett often says that if you own a farm, you don't look at the price every day. You look at how many bushels of corn it produces. A market crash is just a temporary markdown on the price of the farm, but that same farm is still growing corn. Note that gold doesn't grow more gold, but a farm or a company creates something new every year. Dividends continue to be paid, revenues continue to expand, and companies continue to innovate. This is a key differentiator and advantage over speculative assets. Bitcoin, gold, and other non-productive assets may increase in value over the coming years and may even eclipse the value of productive assets. But the odds favor productive assets, and the odds have always favored them over speculation. Here's a quick example. If you took Mr. Kiyosaki's advice 10 years ago in 2016, and you put $100,000 in gold, that investment would be worth about $300,000 today. That same investment in the S&P 500 ETF would be worth $430,000. When I say that $100,000 in the market would be worth $430,000 today, I'm including reinvested dividends. This is the secret weapon of investors who buy productive assets. It's important to remember that this growth happened despite the 2018 dip, the 2020 COVID crash, and the 2022 inflation spike. My point is that the economies in the U.S. and other developed countries have historically been robust engines of wealth creation, even when faced with world calamities. When the people who followed Kiyosaki's advice were holding gold bars that produce nothing, the companies in the S&P 500 were working for you. They were paying you a share of their profits every 3 months, which you used to buy even more shares. In the market, your money works for you. In gold and other non-productive assets, your money just waits for someone else to get scared. This is the difference between an operational risk system and a speculative gamble. Don't let headlines scare you into the supply and demand trap. Build a system based on productivity, keep your cash buffer, and stop waiting. What are your thoughts on this topic? Feel free to share them in the comment section. And if you found this video useful, please give it a like and consider subscribing. It helps this channel grow and reach others who can also benefit from these ideas. Thank you for watching.